You know what I hear constantly? Cash is king. Better safe than sorry. I'm waiting for the right moment, and I get it. After market crashes, after reading scary headlines, keeping money in savings feels smart. It feels responsible. It feels safe. But here's what nobody talks about. While you're being safe, inflation is quietly bleeding your purchasing power. At 4% inflation, your $100,000 becomes worth $96,000 in real buying power after just 1 year. After 5 years, it's worth about $82,000. After 10 years, $67,000. Your safe money just lost 33% of its value while you slept. I've watched this mistake destroy retirement plans for decades. People think they're protecting themselves, but they're actually guaranteeing a slow, invisible loss. And the worst part, they miss the compound growth that could have protected them against that very inflation they feared. Today, I'm going to show you exactly how cash paralysis costs you, and more importantly, how to build a cash policy that actually works. Because the goal isn't to eliminate cash, it's to make your cash work as hard as everything else in your plan. Most people operate on a simple rule: cash equals safety. When markets get volatile, when headlines get scary, when uncertainty rises, they move to cash. They think they're preserving capital. They think they're buying time to make better decisions. They think they're avoiding risk. This logic seems bulletproof. Cash doesn't fluctuate. Cash doesn't crash. Cash is always there when you need it. So when someone has $200,000 sitting in a savings account, earning 0.5%, they feel smart. They feel protected. They feel like they're playing it safe. But here's the reality check. That safe $200,000 earning 0.5% is actually losing money every single day. With inflation at 4%, you need your money to grow at 4% just to break even. But your cash is only growing at 0.5%. That's a real loss of 3.5% per year. On $200,000, that's $7,000 in purchasing power you lose every year just by being safe. Now let's talk opportunity cost. While your $200,000 sits in cash, losing to inflation, what could it have been earning in a diversified portfolio? Historically, a balanced portfolio of stocks and bonds has averaged around 7% annually. Even if we're conservative and say 6%, that's $12,000 in growth versus $1,000 in your savings account. The difference, $11,000 per year in missed opportunity. Add the inflation loss and the opportunity cost together. Your safe choice is costing you $18,000 per year. Over 10 years, that's $180,000 in total cost. Your $200,000 didn't protect you, it slowly bled you dry. Rule 1. Define your true cash floor. Most people guess at how much cash they need. They throw around numbers like 6 months of expenses without doing the math. Here's what you need to do. Calculate your actual monthly expenses, not what you think you spend, what you actually spend. Multiply by 3 to 6 months, depending on your situation. That's your emergency fund. Everything above that floor is opportunity cash that should be invested. For example, if your monthly expenses are $8,000, your emergency fund should be $24,000 to $48,000, not $100,000, not $200,000. The extra cash above your floor is costing you compound growth. Rule 2. Separate emergency cash from opportunity cash. This is critical. Emergency cash has one job: be there when you need it. It should be in high-yield savings or money market accounts. Opportunity cash has a different job: grow your wealth over time. It should be invested in diversified portfolios based on your timeline and risk tolerance. Most people mix these two together and treat all their cash like emergency money. That's the mistake. Once you hit your emergency floor, every additional dollar should be working toward growth. Rule 3. Create deployment rules, not deployment hopes. I'll invest when the market looks better isn't a rule, it's a hope. And hopes don't work when emotions are running high. You need mechanical rules that remove emotion from the equation. Option 1. Dollar cost averaging. Invest a fixed amount every month regardless of market conditions. If you have $60,000 in opportunity cash, invest $10,000 per month for 6 months. No exceptions. Option 2, trigger-based deployment. Set specific conditions that trigger investment. Maybe you invest 20% of opportunity cash if the S&P 500 drops 10% from recent highs. Maybe you invest monthly unless the VIX exceeds 30. The key is deciding your rules when you're calm, not when markets are crashing. Rule 4. Build risk. Circuit breakers. Even with deployment rules, you need circuit breakers. Situations that make you pause and reassess. Maybe it's a recession. Maybe it's a job loss. Maybe it's a major health issue. Define these scenarios in advance so you know when to hit the pause button on deployments. But here's the important part. Circuit breakers are temporary. Set a timeline to reassess. Don't let a 3-month pause turn into a 3-year paralysis. Rule 5. Schedule reviews, not reactions. Check your cash deployment progress once per month, not daily, not weekly, monthly. Daily checking leads to reaction-based decisions. Monthly reviews let you see trends and make thoughtful adjustments. During your monthly review, ask these questions. Am I sticking to my deployment schedule? Have any circuit breaker conditions been triggered? Do I need to adjust my cash floor based on changing expenses? Mistake 1. Keeping temporary cash for years. I see this constantly. Someone sells an investment planning to redeploy the money soon. Soon becomes months. Months become years. That temporary cash becomes permanent cash, missing years of compound growth. If it's truly temporary, set a specific redeployment date and stick to it. Mistake 2. Waiting for perfect certainty. News. Flash. Perfect certainty never comes. There's always something to worry about, always a reason to wait, always uncertainty on the horizon. Successful investors act with incomplete information using predetermined rules, not perfect timing. Mistake 3. All or nothing deployment. When people finally decide to invest their cash pile, they often dump it all in at once based on a headline or a feeling. This is timing risk at its worst. Use systematic deployment over months, not emotional deployment in a single day. Here's exactly what to do. Calculate your true cash floor based on actual monthly expenses. Times 3 to 6 months. Separate your emergency cash from opportunity cash in different accounts. Choose dollar cost averaging or trigger-based deployment rules for opportunity cash. Define specific conditions that would make you pause deployments temporarily. Set a monthly review date and put it on your calendar. Write a 1-sentence cash policy that future emotional you can follow. Cash isn't king when it's losing to inflation. Cash isn't safe when it's bleeding purchasing power. Cash isn't conservative when it's guaranteeing real losses over time. Smart cash management means keeping what you need for emergencies and systematically deploying the rest for growth. It means making decisions based on rules, not emotions. It means accepting that the biggest risk isn't market volatility. It's the certain loss of doing nothing. Remember, this is educational content only. Always verify strategies with qualified financial professionals and official sources before making investment decisions. Your safe choice might be the most expensive mistake you never knew you were making. Time to fix it.